project of rebuilding a reputation, we chose Wells Fargo. And joining me in the group is myself, Erica Wright, Nicole Fight, and Tyrus Jones. Wells Fargo was founded in San Francisco in 1852. It is today the third largest bank in America. It operates by building its long-term relationships with existing customers, unlike some of its competitors who focuses on speed or convenience to the customers. Wells Fargo operate by selling them additional products and services. And at one point, they actually set goals to sell about 8 products or services to each customer. To meet the goal of selling 8 products or services to each customer, there are high monthly quotas that employees must meet. If employees meet these quotas, they are rewarded with commission. If they don't meet these monthly goals, then they are forced to work later or work over weekends, or sometimes they're even threatened with losing their job. As a result, agents or employees felt pressure to meet the monthly goals. And if they were falling short, what they did was looked in their pre-approval accounts and pulled some customers' information and created the accounts without the customer's knowledge or consent. And in 2016, when this scandal first came to the light, it was estimated that about 3.5 million accounts were created without the customer's consent. And because of this, more than 5,000 employees were fired. The CEO, John Strunk, he was also fired, and the company had to pay millions of dollars in fines. As a way to resolve the problem and to also build back the trust with Wells Fargo, we would need to focus on all 4 aspects of the management process. So first, under planning, we need to introduce an integrity initiative. And employees will need to go through mandatory integrity training. And then also we need to outline a course of action for non-compliance of the integrity initiative. And then also we need to make sure we're conducting regular audits. It's important that employees understand that accounts should only be created at the customer's request. Under the organizing aspect, each month we should reevaluate the monthly quotas, remove any sales-based initiatives, and also pay the employees more. If we move away from rewarding employees with commission, then we're moving away from potentially fraud situations in order to make that extra quota or to meet those monthly numbers. And then also, if employees are falling short where they're not meeting that month-over-month quotas, rather than threatening with the loss of a job or forcing to work extra hours, we should offer refresher training. The whole point is to help our employees grow, not to punish them. Under the leading aspect, we should have regular manager meetings to evaluate the new initiatives and make any adjustments as we see fit. Now, under controlling, each individual supervisor, it's their job to monitor their agents to ensure these new guidelines are followed.
Hello, my name is Nicole. The company my group chose was Wells Fargo, and my topic would be the mortgage protection plans. Back in 2020, during the COVID pandemic, Wells Fargo created an extension plan, which was created to help customers when they're late on their mortgage. It helps them hold their mortgage up to 3 months. So if they're due, they wouldn't have to pay it until after the 3 months, and which they called it was the forbearance. Well, Fargo decided that customers who wasn't making weekly deposits should be automatically signed up for the forbearance agreement, which customers was not notified at all. Customers started notifying that their monthly payments towards their mortgage wasn't being credited off towards their mortgage. Many customers was coming out saying that they never needed it in the first place. Many houses was getting foreclosure due to payments not being installed, due to Wells Fargo not crediting their mortgage payments because everything was on hold. Wells Fargo wasn't communicating back when the scandal was happening during the pandemic. So many people was very vile when employees started to reach out back with the customers. And with that information being told, The forbearance agreement had increased interest on their homes that they was paying mortgage on. So after the 3 months was given up, they was really paying towards the interest and not towards the mortgage. So it was unfair for the customer because they didn't ask for that interest and they did not sign up for the forbearance agreement. And the bank was just filling up their pockets and not realizing what their customers was going through. To help solve it, I would say management planning, more meetings with the employees, keeping them updated with the information, because many customers were saying that many employees didn't know about it. Many employees acted as if they didn't realize what was going on with the agreement, or the agreement was canceled, or even the policyholder being canceled. The employees not knowing. I would say planning more daily tasks to ensure that employees are doing their job, to make sure they remember holding up to their policy and to the company motto. And also organizing, making sure that the employees are doing their specific duties, because some can be there doing other people specific duties. And so we have to ensure that they're in line, that the customers are getting what they deserve from Wells Fargo. And with leadership, I would just have different one-on-ones and different teams, just making sure that they know how to handle with different, basically handling with different situations and customers, and making sure the important information is documented. Whatever agreement between the employee and the customer comes to, making everything out and making sure that everything is okay, that the customers agrees to, and they have receipts to come back to, just in case a mishap or a scandal should happen again and the bank cannot prove what's happening. So basically that would be my 4 plans to help with the late mortgage protection and the forbearance plan. So thank you.
Myself, my name is Tyrus Jones, and this is my segment of the project for Management 300. And our topic for our group was Wells Fargo. Starting off with my slide, Wells Fargo repossessed 20,000 cars wrongfully. Wells Fargo needs a culture check before it is too late. With complete wrongdoing, as a director of senior management of Wells Fargo continues with the revelation of this third major consumer fraud on bank customers. As a matter of corporate policy, Wells Fargo wrongfully charged $500,000 of its customers for auto insurance they had already bought and paid for on their own. Wells Fargo admits that it developed a high-level operational plan approved by senior management and the board of directors to force unneeded and costly insurance onto its borrowers. If you have been cheated by Wells Fargo or have questions about your accounts, you are encouraged to contact Wells Fargo for a free case review. What I discovered from studying this was it was completely wrong. And it was to me, it was very going against a lot of federal financial laws, and it didn't make a lot of sense to me at all. And before this project, I didn't hear about this situation. And with the conclusion for this project, I believe, and as a group, we believe Wells Fargo needs a culture check. There are good outcomes to negative solutions. Wells Fargo donated $20 million to strengthen small businesses in Houston just this year in February. The donation comes from Wells Fargo Open for Business Fund, a roughly $420 million national small business recovery effort with a focus on racially and ethically diverse small business owners who have been disproportionately affected by the pandemic. Fostering an inclusive economic recovery and helping small businesses sustain themselves and grow in the wake of COVID-19 is a priority for us, said Charlie Scharf, the CEO of Wells Fargo himself. Wells Fargo Company is a leading financial service company that has approximately $1.9 trillion in assets. The Consumer Financial Protection Bureau ordered Wells Fargo to pay $185 million in penalties and fines in 2016 for creating those unwanted accounts. In August 2018, Wells Fargo agreed to pay a $2 billion civil penalty to settle allegations the bank originated and sold mortgage loans that included false information in the years leading up to the financial crisis. Wells Fargo is worth $1.9 trillion in assets and donated $2 billion. In these events, no one was arrested or imprisoned. Thank you for viewing this presentation and our project with me, Tyrus Jones, Nicole Fight, and Erica Wright.